All right. Welcome, welcome, welcome. Dfi-nancial Friday. We are back. We were off last week. It was a nice little
Yeah.
weekend.
hmm
And I'm excited to be back. Raymond, what you do long weekend? Did you enjoy yourself? Feel like it was finally a little bit more normal?
Yeah, definitely went out to a friend's birthday party, went to a barbecue, had really nice weather. So definitely felt like, some of these things that we haven't experienced for a while came back that 3-day weekend. Hopefully you had something similar too.
Yeah, it was good. Saw some friends that we haven't in a long time. Went down to Southern California, took
hmm
a little drive there, and it was nice. So hope everyone out there who's watching and streaming also felt a little bit more normal and seeing a little bit of that exciting summer travel. I hope coming back, right? But again,
hmm
welcome. This is Dfi-nancial Friday. My name is Alfred from DiversiFi Capital. Raymond, of course, joining me on the show as well. And for those of you joining us, that's new. The show is about talking about finances in an easy and simple to understand way. Raymond and I will usually talk a little bit about what we see in the markets in layman's terms. And then, of course, we jump into talking about a weekly financial planning topic, something that comes up, something that we've seen from clients or friends and family. And what other topic do we get more often than not? And frustratingly enough, so much misinformation about is
Yeah.
taxes, huh? So Raymond and I will have something to talk about where we hear all the time, right? Like, my
hmm
gosh, I owed taxes in April. I owe so much tax. Like, how, like, what's wrong, right? Like, how do I fix that? Like, I'm paying through the nose, all of that, right? And so, but how many people actually understand, like, why that's happening, how much taxes they're actually paying? So, we're going to address some of that. What is true, what is not true, what can help, what can't help, right? So we'll dive into that in the second part of our show today. All right. Um, all right. And so as we get started here, we're going to talk a little bit about the market. And usually, before we begin, we talk about how anything that we discuss on Financial Fridays is just for general financial education, not meant to be for specific financial planning advice. If you're looking for that, well, head to diversifycapital.com, click on Get Started, learn a little bit about how we are trying to, change how the financial industry and financial advisors operate, and something that hopefully is a little bit more fitted for a new generation of how we consume information. Okay. As we talk about taxes, of course, today, also understand that we are not acting as your tax professionals. We, of course, have a deep understanding of taxes as a topic, but this is, again, meant for you to be hopefully start asking the right questions about your own finances. Anything that comes through, make sure you do some research yourself, or if it's something that you can't tackle, make sure to direct that to your tax professional or tax preparer. All right, so let's get started. Again, thinking a little bit about the stock market. It was a little bit of a short week. It certainly felt that way, right? From a work
Yeah.
week perspective. Flew by, came back Tuesday, and here we are with the show. So here we've got some market numbers at the bottom here. What did you see, Raymond, in terms of a short week?
Yeah, so I mean, with the S&P, or just reading through the performance this past week,
Yeah.
S&P is up about 0.61%. Dow Jones is a little bit higher at 0.66%. Nasdaq lagging a little bit here, but still up overall, a little bit under 0.5% this past week. So, year to date numbers, we're still seeing Dow Jones leading the way, S&P kind of just following along there. But we did see some performance from Nasdaq this past couple of weeks. Since we skipped the last week, we didn't quite see that gains from a week ago. But even with Nasdaq not as high this week, Nasdaq's actually up 7.19% year to date, whereas S&P 500, Dow Jones up around 12 to 13%. So a little bit of catching up there from where we saw before. Um, and some of the things that we're seeing this past week is there's been a miss back to back in terms of just payroll gains,
Mm,
which is also serving as just a potential to see that a lot of this help from our government still needs to be there, right? All the stimulus that we've been seeing still need to keep the economy afloat. But overall, in terms of June and what's been reporting back in terms of unemployment rates, that also has decreased. So that's a good sign that people are going back out there, getting more jobs. But it's nice to see some of the growth stocks and technology that did get beaten, the past, the first quarter of this year starting to climb back a little bit there.
Yeah, so jobs are being added, but again, in summary, maybe not as high as people are expecting, right? Still, I think something like 559,000 jobs being added, right? I think unemployment is still up there, right? 5.8%. And, that's going to be something that everyone keeps an eye on. And we on the show talk about these data points. Why are they important? Because it is not only important from a market perspective, but I think it's important to see, like, is there actual growth in the economy, right? Because if the economy is growing, companies are doing well, it drives companies getting better revenues, which then pushes up the stock price, right? Of course, right? Like, there are so many more factors, but these are just some of them. We also haven't talked about, right, like vaccinations and how that is. It's weird, right? I think news ebbs and flows, and you're not seeing as much of this idea of, like, are people getting vaccines, where the vaccines are at. I think it's just assumed at this point is, in most cases, it's open to everyone. If you're going to go get it, you're getting it. If not, right, you're not. And it did read an article, I don't know if you saw this, Raymond, that sounds like there was an increased vaccination numbers once they launched the lotteries. And so maybe it is working, right? And so, anecdotally, certainly feels like a lot of people that we know are fully vaccinated, but also just this idea of travel picking up, right? Planes are full, right? And so, ultimately, if that's being done in a safe way, I think that's good to see, and hopefully things get back on track towards normality, right? Or at least whatever that new normal is. Again, that trend to close out on the market is still there, which is the difference between growth stocks and value and S&P stocks is still a pretty big difference, right? I think you said 12-13% in S&P and in Dow, which is the, again, 500 biggest companies, and the more stable stocks, right, is still about a 7% difference from NASDAQ, which is the growth stocks, right? So again, if you're looking at things to be invested in and buying into, sometimes it's good to just be spread out, right? And you'll notice this year, if that's the case, you'll probably still be doing quite well. I think in any given year, if you told me it would be a 12-13% year in some of these indices, that's fantastic, right? Like, you can't really complain about that, right? And so I think as quickly as information moves now, I still expect that there to be some decent volatility that maybe we haven't seen yet this year. So all right, jumping to our kind of core part of the show, talking about the topic itself. Man, I mean, I will say, even our friends this weekend, right? Like, and if you're watching, yeah, I'm talking about you, right? You were talking about, look, I owe taxes. Yeah, right? Like, I owe taxes. Like, I've never had that happen before. Like, what's going on? Like, I must do something now to lower my taxes, right? This idea of lowering your taxes. Now, look, I'm not out there to be talking about this all the time, but I think it's good to use this show to really say, what does it mean when most people say, Ray, that they're owing taxes? Like, what are they talking about when they're saying they owe taxes? Is it what taxes they owed overall in the year, or is it just the amount of difference in April?
Yeah, I mean, when most, friends, family, when they talk about owing or getting a refund on the other side, it generally comes down to what happens in April, right? Not necessarily how much they paid overall, because I don't think they really look at that number. They're just really comparing, hey, I got a bigger refund than you. Maybe there was something that went on, or maybe you made more money, there's more taxes that you're owing. But they're always comparing just that last number, which is not the best way to compare things, because everyone's situation is different, right?
Yeah, absolutely. And so, but you feel this. I certainly, by the way, it's not that I don't get it. Like, if I get a refund at the end of the year, if I wasn't expecting a refund, certainly it's nice. But if I, planned on getting a refund, that's a little weird, because if I asked you, Raymond, would you ever want to give the IRS a tax-free loan?
No.
Right? Why would you want to do that, right? Why would you want to do that? But yet, right? Like getting a refund at the end of the year is exactly that, right? Because to be clear, when most people talk about owing taxes, what they're talking about is taking what taxes they really paid after all the income and calculations minus what they withheld from their paychecks gives them their net number, right? So in a situation of a refund, their withholdings, what they withheld throughout the year, was too much. Like they just gave the IRS too much money throughout the year, and thus they got a refund. So while they might be happy with that, what they owed in taxes didn't change, right? Like that is a set number. Like that's what we should be focusing on. So someone who owes the same in taxes to the IRS, one withheld more, gets a refund. Like emotionally, they could be happy about that, right? But one that owed the same amount of tax but paid less taxes during the year and withheld less, pays taxes in April, is unhappy about that, except for in this situation, I'm saying they both owed the same amount of taxes to the government, right? So it's really just more of a, maybe just mind tricks you're playing on yourself, right? And so I think that's number one thing right here is identifying that whether you owe in April versus getting money back in April, right, shouldn't really be the determination of saying, oh my gosh, I owe so much tax, right? Because what you should actually be looking at to say how much tax you're owing is something called your effective tax rate. Like on average, if you made $100,000 as a household and you paid a total of $15,000 in tax, all said and done, regardless of what you withheld, that is a 15% effective tax rate that you owe. That's the percentage of tax. And the way to think about that is, hey, every dollar I earned last year, right, I had to pay 15% in taxes on, right? And that, honestly, you tell me, Ray, like, is that pretty high or pretty low in terms of the scale of, like, you know, where we think taxes are historically as well?
It's definitely on the lower side there for the 15%.
And I don't think many people notice or realize what their effective tax rate is, right? Or I think, right, most people have a hard time understanding overall because they're just not familiar and aren't looking how the taxes work. So review with us, Raymond, before we explain again what effective tax rates and what you can do. What does it mean? Like, what happens in tax rates in the US? Like, what is this idea of a marginal tax rate versus effective tax rate? Let's explain that again.
Yeah. So just to clarify, you know, when we look at tax brackets, I think people are familiar with our tax brackets, but not really sure how it works, right? I mean, how many times have we received questions from clients where they're saying, hey, I don't want to be pushed into our next tax bracket because they received a bonus, because they're assuming that every income that they're receiving is going to be taxed at that next tax bracket, right? So just as a reminder, so our tax bracket starts at 10%, 12, 22, 24, 32, all the way up to 37%. Now, for the first 10% tax bracket, that's for income made between $0 up to $20,000 for married filing jointly. Okay, so the next tax bracket is 12%. Anything falling between $19,900 up to $81,000 gets taxed at 12%. Okay, so our tax brackets are marginal, meaning that anything above the past threshold gets charged at that next tax bracket. So going back to the case of a client asking us, you know, should I take the bonus because it's going to push me into maybe the 32 or 35% tax bracket? Yes, we should definitely still take that bonus because it's still income to you, right? So it's not everything falling between maybe like $330,000, which is the starting point for 32%, gets charged at 30%. It's only the incremental portion above $330,000 that gets charged at 32%.
That's a hot take right there, Raymond. You know, offered a bonus, you should take it. Yeah, I hope so, right? But no, I it's funny, like it happens, you might seem it's obvious, but it's not. Like, I think we get that question. It's like, oh my gosh, or to your point, Raymond, and this was covered in shows before, right? We talk about like bonus being taxed at a higher level. That's also incorrect, right? Like, bonus is income and it's all taxed the same way, but it feels like it's being taxed at a higher level because they withhold it at different tax rates, and that tax rate withheld might be higher than how your normal paycheck gets withheld. But guess what? By the end of the year, they sum up what the income was, put the taxes in, check your withholdings, and you still, it's the same thing, right? And it's the same
Exactly.
idea that
Mhm.
withholdings, anything that's happening during the year, right, is just an estimate of what taxes that you are going to owe, right? You're going to owe some amount of
Correct.
taxes once everything is tallied up, but how much did you pay towards that during the year? And that's that idea where
Mhm.
bonus is taxed higher. No, it's just withheld higher, right? So to your point, Raymond, right? Like you have a situation where you have these marginal rates. So all I'm saying is if I average that out, right, then you get
Mhm.
this idea of effective tax rate, which is on average, right? What is it that I paid in taxes for every dollar that I earned?
Mhm.
And, if you're paying 10, 15, 20%, I would say that that's a still fairly like reasonable number. And then as your income goes up, right, 5, 6, 700,000, let's say, right, you might actually get towards effective rates of 30% on the federal side. And that certainly is on the higher end, right? It's on the higher
Mhm.
end. Now, back to this idea of owing taxes. Well, if your effective rate is starting to rise, right? If your effective rate is starting to rise, there's a good chance that whatever you're putting away during the year is misaligned, right? It's misaligned. So, Raymond, tell us a little bit about withholdings and what you can do to change that. So, before we talk about how do you
Yep.
actually adjust the real taxes that you owe, in terms of are there ways to minimize? Let's first talk about like are there ways to just simply say make sure I'm withholding enough or make sure I'm not getting a big refund? What is it that we have to change actually to make those things aligned?
Yeah, so there are forms that you can go through your HR department, or even go online, where you can change how much is being withheld for IRS and how much is being withheld for your states, right? So for California's, that's the DE4 form. For federals, that's the W4 form. So clients might see this as familiar when they maybe start a new job. They'll ask you to fill this out. You have to figure out how much deductions you might be receiving throughout the year. They'll figure out just how much income that you're going to make, and they'll estimate how much taxes to withhold for you. Right now, not everyone's scenario is going to be the same because this is purely just W 2 income. You might be receiving other income outside of W 2, that's not being factored in as part of taxes that you have to withhold for, or even capital gains, right? But one of the things that you can do, if you are able to estimate your taxes that you're going to owe on all your income receipts for the year, is adjust your withholding through your payroll. So that way, every single paycheck that you're receiving is going to be lower, but at least you're putting more towards taxes. And come April, you're going to try to break even or maybe just owe a little bit. So once again, not giving out a free loan out to the IRS or to California.
Yeah, absolutely. And so, right, adjusting your withholdings, okay, is I would say the second point here. So first point is whatever you owe in April or get a refund in April, right?
Mhm.
That's really just a result of your withholdings against your taxes. So I don't know that you need to be happy or sad that that's happening. I think it's going back to understand why you're owing those taxes. Like if in one year you went from getting a refund to the next year owing money, certainly that is odd, okay? But is it because all of a sudden you made a lot more income? Well, if you've made a lot more income, again, your withholding percentages that you've set up may be now incorrect. So now you need to go to step 2, which is adjust your withholdings, right? So using the forms that Raymond said, the form I think in 2020, right, for W4 changed, so they have a
Yep.
better questionnaire, walk you through a process, and help you identify what is it that you need to change, and then you'll see pay stub to pay stub did it match up. So what I mean by that is if you found yourself in 2020 this past year, or this past month and paying your 2020 taxes that you owed money, go check out the W4 form, make sure you answer the questions, and then you would check the next pay stub that comes after that and see if they took more taxes out for federal. How much was it that they took out? So it is a little bit more work, but I think by doing so, it helps you better understand and project, right?
Yep.
And not get a surprise tax bill or a surprise tax refund, even in that case, right? So check your withholdings is number 2. All right. All right. So what we've talked about so far is, in a way, accepting the fact that, right, you owe these taxes, right? But we are going to get a lot of questions from people about, Alfred, that's good and all, but how do you actually minimize taxes? Okay. So if you don't like paying taxes in April, here's what you can do. Withholdings is one of them. But I'm going to say this out loud right now, which is if you are an employee, like you work for a company, you get pay stubs, right? You're not a self-employed. Is there much that you can really do, Raymond, to reduce your actual taxes? I'm not talking about the withholding versus the actual tax, but the actual tax bill itself. Is there much that you can do?
Yeah, I mean, hopefully your employer does offer employer sponsor plan like a 401k. So
Mm-hmm.
that is something that you can participate in. And, if you can participate and contribute to the pre-tax portion of your 401k, that actually goes against your taxable income for the year, right? For 2021, the pre-tax is maxed out at $19,500.
Yep.
So, if you have the ability to max that out, for example, if you made 100K in income by contributing $19,500 towards the 401k, now your taxable income shrinks down to $80,500. That's going to be taxable instead. So that's
Yep.
one way to lower your overall taxable income. Other maybe benefits that's being offered to you through work, something like a HSA or a FSA, dependent care, for example. Those are some of the tax advantage plans where if you contribute to it, it's going to be non-taxable as long as you use it towards a specific purpose, right? So if your company does provide that benefits, definitely get to look into it, see how that can benefit you as well.
So what you're talking about there, Raymond, is hey, you know what? You work for a company. While you might not be able to actually just in general minimize taxes or get rid of taxes, you can defer taxes, right? So what
Mhm.
we're talking about is taking income today, which is what Raymond's saying, in a 401k, put it away. And IRS says, great, you haven't paid yourself this yet, so we're not going to tax you on this. So we call that a pre-tax 401k deduction. And then down sometime in the future, hopefully sooner rather than later, right? And you retire, and by 59 and a half, you say, hey, you know what? That's the age at which most cases, for some retirement accounts differ, but in most cases, that's where you can take out your money. And when you take it out, it will be taxed as income then. So to be clear, it doesn't get rid of the taxes, it just defers the taxes, right? It defers the tax. And it's the same that goes for, right, an HSA, a health savings account, FSA, flex spending account, some of these things, dependent care FSA, all these benefits, right? They're all for particular reasons, right? Health savings account for certain healthcare expenses. Same with FSA, but then there's a dependent care FSA. So if you have kids, right? If you have kids, then and you're sending them to preschool, right, or certain type of like something that right
Yeah.
daycare, that basically when I say
Yeah.
preschool, I should take that back. Anything that allows you to, right, the parents to work, right, and not as
Mhm.
tuition. Okay, so it's anything that is care that allows you to work. Um, you can right say, hey, you know what, I put some amount of money away, which by the way, right, has increased drastically in limits. It used to be a household number of $5,000 you can defer taxes on, right? Now it's $10,000, over $10,000 that you can do, right, based off of new stimulus bills, which is nice, right? Because it helps parents like myself to say, wow, I'm sending my kids to something where they're being watched over and I can actually get some tax benefit from that reduced income. But all the things that we're saying is a reduction of income so that you can pay tax later, right? It doesn't actually get rid of taxes. To be
Yeah.
honest, as employees, there are not that many magic tricks that you can play on your taxes. There just isn't, right? I mean, income is income, right? And so what we're talking about here is, right, being very aware of why, right, you're owing taxes. Don't be so happy if you're getting a refund because that money could have been used elsewhere and invested. You basically gave a tax-free loan, and being very conscious of what your withholdings are to match up, right? To
Mhm.
match up. And so in this case, right, I think, some might say, well, Alfred, then, why do I pay the tax man at all during the year, right? Like, why don't I just, why don't I just pay it all at the end of the year so I'm not giving them any tax-free loan? So what would you answer, Raymond, if someone asked you that?
Yeah, so everyone's tax situation is a bit different, but the IRS is going to want their taxes depending on how much you had sold, any capital gains that you're getting throughout the year. And if you don't pay enough taxes throughout the year, then there's going to be underpayment penalty that's get assessed onto your tax return come April. So
Mm-hmm.
it's definitely an unnecessary cost that we see it as, and definitely can be avoided by either paying more or increasing your withholding, for example, paying estimated quarterly taxes throughout the year, just to avoid that penalty. Because once again, the IRS is going to want their share of the taxes if it goes over a certain amount. Okay, and the way to satisfy or to avoid underpayment penalties is to either pay at least 110% of last year's taxes or at least 90% of this year's estimated taxes. Okay.
Yep.
But that's one bigger reason there is to, instead of just waiting everything until come April, so there's going to be some penalties assessed there.
Yeah. And so, Raymond, your internet was lagging a little bit there, so I'll repeat. I heard you just fine. Your video was
Okay.
lagging just a little bit.
Sure.
But again, you know, paying taxes throughout the year is a requirement, right? Now, you may not know this in terms of needing to make additional payments, but paying taxes throughout the year is already what's happening if you're an employee and have a pay stub, right? Because
Yeah.
it's being withheld paycheck to paycheck. And so, what Raymond is saying is, what happens if you want to take it to the extreme and on your W-4 form, you're like, don't withhold any taxes, right? Because Alfred said, don't give them a tax-free loan. Well, again, there is some amount of taxes you have to pay over time as you're earning income, because the IRS sees it as income earned is taxes paid while you earned it, like right away, right? But they give you some leeway. And that's what Raymond is talking about, is that leeway is either 90% of that current year that you owe needs to be withheld, or between 100 and 110% depending on your income levels using prior year, right? So there are different ways to satisfy that, okay? And so in that case, you can kind of find that blend, and that's why we kind of want to stick towards the idea where, right, your taxes are kind of right in the middle, where you're not owing a whole lot, or maybe you're only getting a little bit of a refund, right? But in that case, you can adjust that with the W-4 form. Okay, to summarize, if you paid taxes in April and you didn't like it, sorry, there's not much you can do. No, I'm just kidding, right? Well, really, what you can really think about is when you paid in April, that doesn't actually mean, right, my taxes were high or low, right? It just means that your withholdings were off. I think that's a very, very good step one to understand. Step two, look at your effective tax rate and then say, what is it that I'm actually paying? Why is it that I'm paying that much? And adjust my withholdings to match that. Step three, if I don't like how much taxes I'm paying, right, it's too high, look and identify, are there things that Raymond said in terms of pre-tax vehicles that you can put towards, like a 401k, HSA, FSA, if it makes sense for you and your family to do that, right, to defer those taxes to reduce what you're paying in taxes today to pay that some point in the future, right? Does it make sense in doing that? That's a whole nother question about whether you think, right, taxes today are higher or lower. I won't get into that. But if you're just simply saying, I want to reduce my taxes today, right, then that's something that you could do, right? And so those are the, basic level of understanding that someone should have around their taxes, yet majority of people don't have it, and that's why we're here talking about it, right? And hoping to give you guys a little bit more insight, giving my friends and family who's watching this some insight into how I and the company think about taxes, so that it's not so much of, right, like, oh man, like just what happened in April. There's so much more to it. Yeah.
And probably one thing I want to add too is just given that there's been a lot of new investors this past year, and us seeing
Yes, I
so
think it's a
much
great point.
gains since last March, last April, for individuals who are selling in 2021, whether it's short term or long term, it's not the same as W2 income, where when you receive income, they're withholding taxes for you, right? So if you're not familiar with taxes, hopefully this show today can give you some insight there. But just be prepared. I think that's really the most important thing, is that I want you to know how much you might be owing, or if you're getting a refund come April, that it's not a surprise to you, right?
Yeah.
But when you do sell stock, there's no taxes withheld on the gains there, but you will owe taxes on it because it's considered capital gains to you for that year. So, if you did sell a lot, you had a lot of great gains, that's awesome. But just once again, be mindful that the IRS and the state's going to want to collect taxes on that. So come next April, either be prepared, do some estimates yourself of how much short-term, long-term capital gains that you received, and that will help in giving you an estimate as well.
Absolutely. And if you're wondering why we haven't talked anything about, well, what about my stock equity? How is that tax? That's a
Yeah.
whole different topic. It does relate to taxes, but we've done a couple episodes there talking about RSU taxation. How, is that different from like your tax differently? Same thing, right? We've done a
Mhm.
couple series on that. So go back to our YouTube channel or Facebook and search RSUs, and you should be able to find something there. If you're at our YouTube, go under Money Mythbusters, a series we did last year, where we kind of just talked about different financial myths, and well, we talked about why they were true or not, right? So there was an RSU one in there that I think would be a very good watch for you guys to understand how RSUs are actually taxed. All right. Cool. Well, another Friday show right on the mark here. Happy to be back. If you guys are interested in learning more about all the different topics that we talk about, again, I would say go to our YouTube, check out our different playlists. You can see all the different shows that we have done. Drop us a like, subscribe to our channel. We're always coming online here, streaming to you guys across the platforms. Friday, 3 p.m. Pacific, unless there's some holiday, right? And so we look forward to seeing you guys next week. We'll be back on with Raymond and talking a little bit more about these topics that we hope that you guys enjoy.
Yep.
All right. Have a good one.
Yeah, you too. Thanks, everyone.